Okay, everybody, the long-awaited trading strategy. How do I do what I do? I would consider myself now at the professional level. It took a lot to get to where I am. I've been doing it 8 years. It hasn't been easy. There's been a lot of ups and downs, but now I'm personally doing this because I don't want to. I find I'm drinking too much, and if I do this, it'll keep me accountable, so I can be more accountable to my followers, help them out, and guide them. It's just easier if I'm a mentor, and then it just keeps me in check more. So that's why I'm doing this. This is more for my personal help, and hopefully I can help you along the way. So I'm going to start with a disclaimer. I am not investment advice. I don't look into any fundamentals for any company, nor do I care what any company does. So never ask me, what should I buy? Because I'll never tell you to buy or sell anything. Just see what happened to that talk to a girl and ask her for investment advice. See how that goes. So things you will need to understand. I suggest you write these down. These are important. It's kind of a group thing that you need to understand all these things together to be able to understand what I'm telling you. You'll need to at least 5 to 10,000 US to run this strategy. You'll need to know all the basics of charting, and what does that mean? You'll need to know candlesticks. What do they mean? Each individual candlestick tells a story. The color of it, the body of it, the wicks, everything, how it closes, everything is important. Each individual candle tells a story. You'll need to know candlestick patterns. Candlestick patterns are 2 to 6 candles in a row that might signify a reversal in the trend or something's happening. You'll need to know candlestick patterns too. You'll need to understand trends. Are you in a long-term uptrend, a downtrend, a daily uptrend, a weekly uptrend, monthly uptrend? You'll need to know these. I generally only play monthly, weekly, daily uptrends. Like for the most part, like that is what this trading strategy is geared towards. So you'll need to know charting patterns. You'll need to know what kind of reversal patterns there are out there. Continuation patterns. So once it makes a big move, what should you be looking at for that it's going to make another big move? Or is it making a reversal and going to head back down? Or an equilibrium. So what you would like to see after a big move up is an equilibrium into another big move. It's showing that there's power behind this move. You'll need to know supports and resistances, how to play off them. Like where would be a major support? Where would be a major resistance? My personal opinion, that's why I play blue sky breakouts, because resistance is the enemy. You don't want to be dealing with resistance overhead. The least amount of resistance overhead, the higher the success rate of your trading. I'm going to try and dumb it down as simple as possible. Like this is what I'm trying to do, and I'm having great success this year. Understand why volume is important. So when a stock makes a big move up, if it's matching the volume on the way down, well, that's a red flag right there. You want to make sure there's decreasing volume on the way down to make a higher low and then move forward from there. And finally, you need to understand how to use the TradingView app itself. It is important that I use TradingView. Most people use TradingView. It is a paid app. You do have to pay to get live data, and live data, you can't trade without live data. That's plain and simple. So TradingView is what I use. I do all US stocks. Canada is uninvestable as far as I'm concerned. It's been that way for a long time. There's no good startups. They're terrible for big business. Anyways, need I digress. What I do is professional level trading, so don't expect it to be easy. It's not hard to learn the basics and understand the language. It took me about 2 weeks. I started getting it a little bit. A month I was kind of seeing things pretty well. So you have to have some dedication here. It's not just pick away and be lazy about it. I focused. I went hard for 2 weeks to the first month of learning how to even look at a chart. I know that's the hardest part of it, is just what am I looking at? You need to understand that. So I don't do that. I don't do those. I'm not building people from the ground up. At this time, I don't have the videos to support that, but I can send you a link to another established group, their training videos, My Old Mentor, for the beginner videos. I do not need a mentor anymore, and I feel like I can give better, more helpful advice. So you'll also need to know how to use indicators. I don't like to crowd my charts with indicators. I like to keep it basic. I use exponential moving averages and RSI, relative strength index. That's all you'll see on my charts. I keep it simple. You don't need 30 things on your chart. It's not worth it. It costs more money if you want to pay for the professional version of TradingView, which I do, but I mean, I don't really need it. Yeah, keep your trading basic. You don't, yeah. There's tons of YouTube videos about using those indicators. So yeah, learn how to use the exponential moving averages and RSI. You'll have to learn about trading options. This is a big one. This is if you don't have the capital to invest big amounts of money, this is where options can take you from a small amount of money to a large amount of money, and well, or go to zero. But it's ultimately it's leverage. So every option contract, it's the right to own 100 shares on a certain day at a certain price. So it's kind of like betting that it's going to be at a certain price on this day when it expires. So you're playing the volatility of that contract. They're 10 times more volatile than stocks. $5,000 worth of options move like $50,000 worth of stocks. To be put simply, it's a very leveraged stock trading system. You can watch other YouTube videos on options to get better at understanding them. I won't be teaching them yet. If you are a beginner at options, just practice with one option contract at a time so you can see how they move. Unlike regular stocks, they can very quickly go to zero if you don't know what you're doing. Because regular stocks, like when they drop, they don't drop to zero generally. There's a few anomalies like Enron and stuff like that, obviously, that have gone to zero, but they'll bounce, and their stocks are easier to set stops and be more safe. This is a less safe way of trading as far as having stops and knowing having levels to get out, but I'm going to try and explain that as well as I can. And but anyways, okay, so now for this trading strategy itself. What is this trading strategy about? It's focusing on all-time high breakouts, getting into risk-free positions, and then just letting your winners run. So on average, my trades are probably anywhere from 4,000 to 8,000 per trade. I go on the lower end if it's less of a popular name, or I guess less, if there's less liquidity, or it's a kind of a beginner company, less established company. The blue chips, I'll focus on higher trades, anywhere $8,000 to $10,000 trades. And like that's about $100,000 worth of actual capital you would be hypothetically using to leverage. So yeah, letting my winners run. I play a small bounce, and so options being 10 times more volatile, I like to after a 20% jump bounce, I will set a sell for sell 75% of the option contract at 25%. So I just let that run. So for an $8,000 stock, it would be around $2,000. I would be letting run, and the rest I'd be basically taking my money back and then just letting that go and ready for the next trade. I try and get in and out as fast as possible. And then as soon as I'm out, I call that a win. Contrary, if there's no bounce, or the bounce happens and I don't manage to get risk-free in that position, then I'll explain later on what I would be looking at to get out, and I would call that an unsuccessful trade, a failed trade. So this may sound stupid simple, but I'm telling you, it does work. I've developed this system to be more of a relaxed trading system so that you could do it alongside a full-time job during the day. Basically, you will get your alerts each morning, and it's really up to you whether or not you are willing to take the trade or not, or if you're too busy at the time and the alert goes off and you can't get to it, so what? Just wait for the next trade. Don't chase after things. You need to detach yourself from FOMO buying and start being comfortable buying the pullbacks. That is what the professionals do. Stop buying the breakouts and chasing. If you're getting too excited to be in a trade, don't do that trade. Like that, a lot of times that will backfire on you. You'll buy the top, sell down here, and then it'll go because you're scared because it's, oh, I buy a breakout, it goes further. I'm like, yes, and then you get into a negative trade, and then people get scared. It's just psychology. You buy the pullbacks, not the breakouts. Okay, so this is essentially every night after the stock market closes or in the morning before the market opens, I will look up every stock that has made a new all-time high that day. From this list, I will go through each ticker and see which ones have the best liquidity. And I want to see at least $50 to $100 million worth of shares traded each day, at least. This is important because options do not work for illiquid names. They usually have giant spreads. So show them the process. I need to Trading View. I should have had this tab. Trading View all-time highs. I didn't have this trade. So okay. So this is I'll give you the link for this. It's just Trading View. You just in Google you can type in Trading View all-time highs, and it gives you this list. But I will put it in the comments or in the write-up. So on Friday this week, 76 names got new all-time highs. From these names, I only shortlist these names. I will look at basically the volume of the shares traded. I will only trade shares that have millions of volume. These are illiquid names, the ones that have hundreds of thousands or whatever. They're very illiquid names. You could get trapped in that. Just don't trade options unless they've got millions and millions of shares traded on a daily basis. So, volume. This ticker is Amazon. It traded 25.89 million shares on Friday with a relative volume. So relative volume is like the last 5 or so days or 10 days. Relative to the last 10 days, how much volume was traded. So the reason why this is important is because, since it's 0.81, so that's actually less than the volume that has been traded. So that's telling me it's consolidating on less volume. So that's a good sign. It's just kind of putting all the pieces together for me. So relative volume. Relative is 1. So 1 being the average over the last 10 days or whatever they deem the average. And so in the event that there's say there's 100 million volume, but the relative volume is 10. So this is that would mean that it's an anomaly. It doesn't happen often, and it could be a one-time event. So you want to make sure that, okay, this actually does trade enough volume on the regular basis. This wasn't a one-time thing. You want to make sure daily, every day it's trading at least $100 million worth of shares. That's kind of my bare minimum, to be honest. So I go through which ones are the liquid names, which ones I can add to my short list. It doesn't matter what sector they're in. I do not care what they do. Like I said, it's just find the names that have liquidity, and that I'll add them to a new list every day. And from there, I mark 15-minute, 1 hour oversold, and 4 hour oversold. I'll set alerts for those time frames. So on a pullback of the 15-minute pullback, or a 1 hour pullback, or a 4 hour pullback, those are my alerts to trigger a buy or start looking to buy. Let's see. Okay, so from those tickers that I've chosen, I will set alerts for 15-minute, 1 hour, and 4 hour oversold. So anytime a good ticker, new all-time high, I set these 3 alerts every time, And so that's just the names that I play. It just makes it easy. It's like takes 15 minutes tops every day, and I'm prepared for the next couple days because it might not trigger these. It might, like, especially 4-hour oversold. It's going to take days to get down there generally, and if it doesn't take a day to get down to 4-hour oversold, like there's something wrong. There's probably bad news of some sort. So when an alert goes off, that brings to my attention that ticker. From there, I make sure this isn't news related. You don't want to be buying it just because it made this. If it is going down hard very fast, you don't want to be buying it and then realize after it's based on bad news. It are also earnings related. Things that are news related or earnings related, they can get very extended. They might go for a few days of very hard sell off. Like generally when there's news related or earnings related, they call it the 3-day rule. 3-day rule, do not touch it, because it could cause extreme oversold or even overbought conditions. So I mean, it could go both ways. But yeah, stay away from news. If it's news, don't touch. Oh yeah, and also make sure there's isn't massive volume on this move. You don't want the volume going down dwarfing the volume from the previous couple days, because that's telling you more people are trying to get out of this trade than are interested in coming in. You want to see the volume decreasing on these pullbacks. That is a very key. So volume is very important. Understand volume. So yeah, look at the previous days and compare it. Make sure it's less. Show them the rest. Just 1 second. So yeah, basically here is an example. Volume is decreasing on this pullback. That is what you want to see. So that's on the daily time frame here. We capped out, we peaked on volume, now we're dropping volume. That's what you want to see generally for pullbacks. Okay, so when I'm looking at buying options, what am I looking at? I'm looking at options that are on different time frames. So if I'm buying an option that's on daily oversold or 4-hour oversold, I'll generally look at option contracts that are 2 months out. That's because it gives you time for it to play out more. You don't want to be buying weekly or single monthly options on a 4-hour based time frame. I'll usually go 1 month out for 15-minute or 1-hour oversold. See, everything's kind of relative. Like, you got to plan around that. Also, I make sure when we're pulling back, I make sure that you're buying option contracts that are in the money. That means the option contract is under where the price is. So you want to make sure, because if you're under an option contract, so say I buy 100 calls and when it expires it's at 90, that means that option has gone to zero. Everything under 100 goes to zero. So you want to buy an option that is in the money or at the money, and so when you let your runner go, that hopefully by that time it's well into the money by the time it expires. It's when you start buying option contracts, yes, they are cheaper when they're out of the money, because it has to make a more drastic move to get to where you're going. But the thing is, you're expecting it to make it to that level and then some when you do that. Whereas if you buy at the money or in the money, it doesn't have to go extreme moves to stay profitable in these moves. Okay, so the spread of options, that is important. Try to avoid market buying options unless the spread is very small. So the spread, just for regular stocks, the spread is the difference between the price, the bid, and the ask. So the bid is the price that people are willing to buy it at, So 104, and just for United Airlines, 104.90, and then the ask, this is the price people are willing to sell it at. So 104.94. That's a 4 cent gap. So that's called the spread. So options have much larger spreads than stocks do, because each point, every cent on an option contract, you times it by 100. So like one penny is worth $10, and so if like generally a lot of times you'll see the spread is 10 cents. So that's the difference of $100 between the bid and the ask. So it's important to find spreads that are smaller, and so when you're I generally always limit buy. So if I see it's getting down to a level that I want to see it flush at, I will set a limit buy and let it come to me, unless it gets to that level and it's a little bit above where I set my limit. I might raise it a bit just to make sure I do get into the trade, because it could bounce right above where I set my limit buy. And generally I will avoid market buying unless it's names like Amazon, all the big blue chip names, because then you could just market buy it. The spread's probably the same for like a small spread in these type of names. So that is important. So as soon as I get into a trade, whenever I buy trades, say I buy these options, I'll buy whatever, I'm saying 10 options for $1. I'll automatically set my sell for $1.25. I'll sell I'll sell 75% of my options at a 25% gain. So what that's doing, it's getting my initial money. It's not exactly your money back, but basically it gets you into a free trade. That's the way I see it. So the reason why I play the all-time names is because when they do these 15-minute, 1 hour, 4 hour oversold bounces, there's a higher chance, the highest chance possible, that buyers will come and buy it, and you will see that bounce. In any other instance, it lowers the chance that there will be buyers interested. There's a reason why these names are at all-time highs, and they're the ones that are going to be bought up first. That's why it's so important about this strategy. Is this pullback coming directly from an all-time high? That is very important. So anyways, yeah, sell my 75% of my options. So my entire options, they go up 25%. I'll sell 75%. Just let my 25% run. So in this instance, if it was $1, I would sell 70%, because I can't really break it down to 75%, but I will sell 77 of my option contracts and let 30 or three options go without me. And yeah, so and I will just let those options expire. Essentially, that's just my runner, and I let those options go until they expire. So hopefully they just go and they keep making money. And in a bull market, it's very powerful. It's a very powerful strategy. And when you start getting into these blue sky breakouts, crazy things happen. Like we start seeing hundreds or thousands of percent. They move. And yeah, and that's the thing. I wait for these trades to come to me, and so I don't get FOMO. And I've already got money in other trades going. So if I'm not getting these alerts that I'm setting every day, that means I'm making money, because everything's just going. It's a good system. Anyways, okay. So explain. Basically just walk away. Okay. So what if one of my trades is going against me? It depends on which time frame you're focusing on for buying these oversold conditions. So in this instance on United Airlines, if I'm buying the first hourly oversold, which it did on this point here, say it bounces and it doesn't make enough to get me 25% and get me out of a trade. So 25% is just like essentially 2.5. I'm just looking for measure. So this bounce was actually 5.5%. So I mean, chances are I would have been able to get risk free. But say this didn't get me risk free and sell in this bounce here, and it starts coming down. So if on the hourly time frame, I'd be waiting for a 4-hour bounce. So obviously this broke above these levels here, and so if it managed to break above and start a 4-hour bounce, and that 4-hour bounce tops out and it starts breaking down into lower lows, I would very highly you should sell at that point, just to make it easy. Call that a loss, because if you wait for that 4-hour to bounce, so when we get hourly oversold, we're waiting for a 4-hour bounce essentially, and if in that 4-hour bounce you cannot get risk free and it starts heading lower, either hopefully you can get out break even, but if it breaks down to a new low after making a 4-hour lower high and making a lower low, those 4-hour lower highs and lower lows can get very extended to the downside. It could go to zero, and which options love to do. So yeah, hopefully you can get risk free on these bounces, and that's essentially what I do. It's just blue sky breakouts, the highest chances. So I said I was going to go over my trades, my trades that I've done this month. So United Airlines, this was one I missed. I only made one trade the last week, and that's because the market's just been absolutely flying. It was gap up opens with little ranges on the S&P 500. So it was like I only got a few alerts. United Airlines, I got 15-minute oversold alerts, which I didn't feel like buying. I was busy in the week too, so nothing was interesting. But in return, that means everything that I bought last week, that means it was rallying. Everything I'm in from the previous week, if you're not getting alerts, it's because everything's rallying. Good news, right? So I did have an alert set here for 1 hour oversold on United Airlines, which it triggered right here, and then it flew up 5.5%. So you only need 2.5% really in a day to get risk free. So this it would have been a successful trade essentially, is what I'm saying. But yeah, we're heading down. So, but who cares? I'm in a risk free trade. Move on without me. The next trade I did, not the next one, but just another trade. Apple on the 4 hours oversold. So where are we? Apple. Is this Apple? Yeah. Apple, we hit. Oh no, sorry. That was on daily oversold. So the reason, this is one of the weaker names for sure right now, but this is the first time we are getting daily oversold since all-time highs, and it's kind of like a straight shot down. The last time we hit daily oversold, right back here, March of 2024. That is the last time we hit daily oversold on Apple. And I mean, eventually you see the run that happened after it. So when I'm looking at daily oversold, I'm looking at 2 months out. So 2 months out from March 7th, March 6th, April, May. Well, this would have been, around here actually. So fortunately, I would have gotten risk free in this bounce here, and then my profit would have just made a little bit more, not too much more though, because we did trade sideways. Sideways trading is not good for options, because it's just as time's going on, your options are decaying, which you should know because this is professional level trading. So anyways, we finally hit this condition off of the 200 exponential moving average. We also had this support here, which it broke by a couple pennies, and so I got into a risk-free position. Let's see what. I was playing off this support, 220, and I'm like, if we break this bottom was 219.47, and my note was, if we are daily oversold and we break 220, I will make an entry. Which we broke 220, we went to 219.38, and then we bounced 3.5%. So I only needed 2.5%, and so I managed to get risk free on this bounce, and I have March calls from here, so I have quite a bit of time. Hopefully we have a good earnings and we start heading back up, but I have a lot of time for this to play out. And well, the calls I bought 220 calls for March. So if we keep going down and we close below 220, or by the time my options expire, if they're below 220, my profits are going to zero. But it's okay. I'm risk free. Doesn't matter. And I mean, we are looking pretty weak because we already topped out on this daily bounce and started making a lower low on this day. So looks like we're heading down. And I'd be interested in playing a breakdown further, playing off this level, and playing a break of 200. So the next trade, RGTI, quantum computing. I bought the 4-hour oversold. This is when this was a 75% drop. It was quite significant. So I did play this first oversold bounce, and my mistake was I accidentally bought weekly options. I was not paying attention, and I bought weekly options, and I didn't end up getting risk free because I didn't get the trade. Like I didn't hit. Yeah, I didn't get risk free, and then because they were weeklies, they expired. They expired on the Friday, and so it went to zero very fast. It was not good planning on my end. I should have been buying 1 month out because I would be in the money by now, or 2 months out. Sorry, at least 1 month out, but generally 2 months out for 4-hour oversold. Because it would have been a successful trade, but I played it and I'm like, whatever. It wasn't a big trade. It was only like $1,000, so I'm like, whatever. Whereas we got a second lower low, and I was like, okay, now I'm very interested. We were oversold on all time frames. Except for the daily, but I played a break of $7 and a break of $6, which we bottomed out here at $5.50. And we've gone well over 100% since. So I'm in very risk-free positions. I'm up hundreds of percent on my options, and I'm just letting them go. So I'm hoping essentially this gap fills. I might actually take more profit because this is a huge bounce. Like this is not like over 100% in a couple days it went. So yeah. That was those trades. So in total, that was 3 trades. One went to crap real fast, and the 2 other trades, they were month out calls, and they're well in the money now. So $5 calls. I bought $5 calls when it broke $7 and when it broke $6. So Palantir, what was my note? A break of 67 and 65. On which time frame was I interested in? Oh. Yes, it was on 4-hour oversold. So once we hit 4-hour oversold, I played a break of 67. So right here, I played this, and we ended up going lower. So I'd said I'll play one last bounce or a break of 65, and we got down to 63.40, and we bounced, and now I've got risk free on that trade. So overall, I made 10 trades this year. I didn't trade the first couple weeks, and then the third week I traded a bunch. And then this week, I only did 1 trade. So yeah, 10 trades, 9 successful, 1 unsuccessful. And the reason for that, we play all-time highs. There was just, yeah, I was playing this because it was also coming to the 50 daily moving average too. So that was, when you have other things coming together, that's what makes these trades more successful. OKLO. So from this all-time high, I played... This was an interesting one. So from this all-time high, I played this first oversold bounce. So you see it gets oversold here. I bought on a break of 25. It went down to 24.77, and it bounced 9%. So I was obviously in a free trade at this point. I like to, okay, so that's another thing. When I'm scouting, I will, when we hit these oversold conditions, I will look at generally I will look at levels. So is there a support nearby, or is there an even number? So like 25, or not an even number, but is there a significant number, like a psychological number that is nearby that could end up being a support when it flushes? They're just trying to flush that number, like any 10s, 10, 20, 30, 40, 100, these significant numbers, if they break, or a 5 in this case, but yeah, the alerts just alert me to the stock, and then from that, I generally want to see another flush of other levels before I make these entries. And when you're letting these trades come to you, there's just higher probability that it's going to work out for you. So yeah, I got risk-free on this bounce here, and we did end up falling a whole bunch more. But it doesn't matter because I'm in a profit trade, and we ended up climbing quite a bit more. So I was up hundreds of percent at this point, and I ended up selling because I was expecting a lower high, but that didn't end up happening. It ended up rallying a whole bunch more, and I would be up 1,000% at this point. When you have monthly calls and it runs up 100% in a few days, you're making 1,000%. It's crazy how fast options work for you. What are we at for time? 36 minutes. Not too bad. Getting close to being done. So FTAI, here was an example of a successful trade, but it died on me. So when we, it's crazy how this works. So from this all-time high, I bought the first hourly oversold, which was actually here. And what did I play? I probably played a flush of 150, and from there, I'll see what we got for percentage. Yeah, we got 4%. I finished this trade within the same day. I already had my money back and was in a profit position. So it bounced 4.13% from approximately where I got in. And then the next day, a short report. Ideally, I like to be in and out the same day. So when it does a flush first thing in the morning, I trade the first 3 hours of the day. Those are generally all my trades come from the first 3 hours, because that's when things like to flush, and then they make their move to the upside. So then they close towards the high of the day. If you're in something that jumps a whole bunch and then falls down for the rest of the day, then it's likelier you will see more downside the next following days. So anyways, yeah, got risk-free here. Then a short report came out the next day, and it was down, I think it was like 40%. And I'm just like, okay, this went to zero. There's no coming back. I bought 150 calls for a month out, and we dropped down to 76 here. Basically, you don't want to be in something when it has to go 100% just to break even. That's crazy. So this option's toast. It's gone. And I will say all my bad trades. I'm fine. Everyone. No one's flawless. It's just not a thing. I just focus on this so that I get the highest success rate. My rate is high. I'm fine admitting my losses, which you don't really see people talking about their losses. So MBLY, this was another trade I took. Why did I take it? What triggered MBLY? I triggered a break of $15, but what was the trigger? It was on this giant drop here, so we must have hit 4-hour oversold. So yeah, I got alerted to, this wasn't even an all-time high name. I just see a lot of action on Twitter talking about it, so that's what got me interested in it. Just I like playing hype. So if I see something and there's a lot of hype happening, a lot of chatter on Twitter, I will go investigate. Anyways, I saw something that was so easy. It was I'm like, oh, okay, we're 4-hour extremely oversold. If this breaks $15, I'm just going to buy 2-month out calls and break of 15. I've just bought 2-month out calls, and obviously it would have been 15s, March 15 calls. And what do we go? So far, Yeah, around flush of 15. So yeah, we ran 18%. Obviously got out. I'm risk free, have a 2-month position of just profit. So letting that do whatever it does. It's possible we might break down more. Actually, it's getting even more likely because we're still bear flagging here, and it's looking more likely. We'll see. Earnings will dictate that as well, obviously. But yeah, risk free position. Moved on with my life. Also, when things hit 4-hour oversold, they come off my list. It's off my short list. I do not care to. I don't want to see that ticker again until it makes a new all-time high. So you'll see, like, if it's a strong name, it should make a new all-time high. Being 4-hour oversold, buyers should come and be eager to buy it up. And that is why this strategy is so successful. And what else we got? Okay, so, BTDR. BTDR. Why was I interested in it? Around 1690. Okay, so we got to, was it 4 hour? Yeah, we got to 4-hour oversold, and I preemptively bought. I actually didn't play the break, the flush. I was thinking that the support was going to hold, but I bought it anyways. 4-hour oversold. I bought only monthly calls, so it's February calls. I would have bought probably 15s, maybe 20s February calls. And yeah, so we ended up breaking this support back here and straight into a bounce. And from 1639 all the way up to 2327, that was a good enough bounce to get me out and risk free. Okay, so from there, obviously, this is in blue sky breakout mode. We are still in a bull market. There's everything's going well. So what if there's no stocks making new all-time highs? I go through my list and there's no new all-time highs. Well, that should be kind of a red flag. We're like, why is nothing making new all-time highs? That should get your attention. And like eventually there'll be a time where there's a crash and all my profit positions are going to go to zero. Chances are. Like, I mean, there's less likely, or they'll hold up the strongest story, but there's a high chance that everything will go to zero. All my profit positions. But it's profit. So anyways, yeah. What if there's no stocks making new all-time highs? Well, then we move to stocks that are still at 52-week highs. So there's also you can see which stocks are at 52-week highs. So they're not at all-time highs, but they're in their strongest uptrends. They're at their highest point in the whole year. So from those 52-week highs, we could still do the same strategy, but there's a little bit more overhead resistance. So they're slightly less likely to be successful compared to an all-time high name, because they're only at 52-week highs, not all-time highs. So there's more resistance, the enemy. What if there's no stocks at 52-week highs? Well, just like blue sky breakouts, we can move to stocks making new all-time high or all-time lows and use that same strategy, but in reverse. So if you see what I'm saying, it's the exact same, but in reverse, because clearly these are the weakest names. They could be scams. They could go to zero. They're the most likely to get hammered the hardest. So I hope this video was useful. Like I said, in the beginning, there's a lot of things that you need to know to get all this to be working together. So focus on those things. Options are a crazy thing to know. So they're the riskiest thing to know. You need to know the movement of options. Trade one option at a time. Just see how they move. You'll see how insane this is, and focus your option on an all-time high name in the money. So that's everything. I hope you enjoyed the contents. Someone's here. So yeah, thank you for watching my video. I hope it was useful to you, and I will talk to you in the future.